to go to, and I think why did I choose this topic? As Gaurav mentioned, during my long stint with PwC, I did a number of lines of service, audit, forensics, etc., etc. But the one I enjoyed the most was my last 5 years as head of corporate finance. I enjoyed the thrust and parry of deals. I enjoyed the adrenaline flow when you're working on a live deal. I really enjoyed that. And what is more, I found that most of the young interns and graduates who joined us, they also seem very interested in corporate finance. Most of them would say, it's cool, dude. And as far as I understand it, that is the ultimate compliment that people in your age cohort can pass. When you say something is cool, then it's always something that you like. So when he said, choose a topic, I chose this topic, deal or no deal. So let's start off with the deal or no deal. First, an introduction. Z, can you just move to the first slide? The introductory. So the deal landscape, although I say deal or no deal, currently it seems to be, yes, the deal is on, because there's frenzied activity in deal making. It's reached a feverish pitch. So in the first quarter, in the first 9 months of this year, there have been over 27,000 deals with a combined value of 3.4 trillion. And based on the activity that's going on now, most people think that by the end of the year, the deal value would have exceeded the 4.2 trillion, which was the last record set in 2018. And the majority of the deals have been done by strategic buyers. I don't know whether, just let me explain. Maybe some of you do and some of you don't understand what strategic buyers are. Strategic buyer is a company that buys another corporate in a business which is quite similar to or complementary to its business. So it's another company buying another company. And then you have what you call financial sponsors, things like private equity funds, venture capital funds, and they are called financial sponsors. So whilst majority of the deals have been done by strategic buyers, financial sponsors now account for nearly 40% of all M&A activity in deal value and numbers. And there's a reason for that. As interest rates tanked, and interest rates were less than 1% at one point in time, they even became negative in certain countries. And as populations aged, a lot of these pension funds, etc., could not rely on deals to pay off their pension liabilities. So they started moving their funds, and they control a lot of cash. They started moving into alternative investments, such as private equity funds and venture capitals. And that resulted in a lot of dry powder with these venture capitalists and private equity funds. I mean, last account, private equity had almost 1.5 trillion in cash that they had to deploy. And that has resulted in a lot of activity. I mean, if some names like ByteDance, SpaceX, Checkout.com, Revolut, these are names you would have heard of. And these are all examples of startups that have been funded by venture capitals. In 2020, there were only 20 unicorns in Europe and Israel. And in 2021, in the first 9 months, there have already been 70 unicorns. A unicorn, as you would know, is any startup that has achieved a valuation in excess of $1 billion. So that tells you why there's so much activity going on. And then the other reason for is the emergence of a new concept called SPACs. I don't know how many of you are familiar with the acronym. SPACs stand for Special Purpose Acquisition Companies. So nearly 200 of them went public in 2020 and raised 60 billion. So some of the names that have used SPACs, you may not be, you'll be familiar with them, is something called WeWork. Adam Newman's shenanigans. The IPO failed, and then WeWorks used a SPAC to go public, and they went public at a valuation of 9 billion, which was much lower than the 40 billion valuation pre-IPO. But nevertheless, they used SPAC. And the other companies that have used SPAC is BuzzFeed, you would have heard of, or OpenDoor. These are all companies that have used the SPAC route to go public. So this is the reason that today you have, notwithstanding the uncertainties of COVID, you had a very, very buoyant, a really frenzied deal activity scenario in the world. So with this background, we move on to the next slide, which is what are the highlights. So I've given you some examples of some of the mega deals that took place in 2021. There is the 20 billion deal between Microsoft and Nuance, the convergence of technology and healthcare, uh, the deal between Wohnen and Vonovia. These are real estate developers, the number one and number two real estate developer in Germany. And then you have the mobility in the mobile technology, the merger between Rogers and Shaw. These are two top companies in Canadian mobile telecom, and they merged on a 26 billion deal. So these have been some of the hot sectors, and these are just examples of three very large deals that took place in 2021. Can we move on to the next slide? So what are the factors that you need to consider when it comes to making a deal? And I've tried to list out here the main ones. There are a few others that have to be taken into account. But here are some of the main ones, which I've said I've divided into two. One is the strategic rationale, and then there's the financial rationale. So complement the existing business. So that is a very strong strategic rationale. An example of that would be the deal that we just spoke about, the two deals that we just spoke about, which is the Shaw and Rogers Communication coming together, both in the mobility business. They decided to merge. The number one and number two, they decided to come together. Similarly, the number one and number two developer, real estate developer in Germany, decided to come together. You're complementing the existing business. Achieve geographical diversity. Example of that is Walmart purchasing Flipkart in India in 2018. Because clearly, this was a market that was ripe for explosive growth on online retailing, and Walmart paid 16 billion to get into Flipkart and to make an entry into the Indian market. Drive synergies by combining similar businesses. Here's another, this is again a very dominant theme for undertaking M&A activity. So the examples of drive synergies, if you look at Disney's acquisition of Pixar in 2006 or of Marvel in 2009, these are fantastic examples of businesses that were able to derive synergistic benefits. On the other hand, if you look at Google's acquisition of Motorola in 2012 or Microsoft's acquisition of Nokia in 2013, these are disastrous examples. The synergies that they expected never arrived. So if you can drive synergies, that becomes a very, very important reason for undertaking an M&A activity. Then eliminate and preempt competition. Well, the most famous example of that is Facebook's acquisition of WhatsApp in 2014. So Mark Zuckerberg paid $19 billion for a business that had revenues of less than $1 million. And now that some confidential data has been released from Facebook, it's clear that one of the reasons Mark Zuckerberg bought WhatsApp was that he thought it would kill Facebook if he didn't preempt competition and eliminate it by acquiring WhatsApp. So that is a classic example that's always quoted about why sometimes you undertake a transaction merely to stop another company from entering the field that you're in. And then finally, acquired technology. That's become a very, very important reason for taking on an acquisition. And one of the best examples of that is the one that I quoted at the beginning of, there is obviously the Microsoft and Nuance. And another example of that is when AstraZeneca acquired Affixon for about $39 billion. Now, AstraZeneca was not very strong in rare diseases, whereas Affixon was. And so forth, they were willing to pay $39 billion to get into a field where they thought they were weak. So that was acquiring technology. So that is a strategic rationale for doing a deal. And then there's a lot of reasons why, for financial reasons, a deal takes place. Excess cash. Obviously, when treasury yields are at 1.5%, you're not earning enough. You're barely beating inflation. So you've got excess cash on your balance sheet. And all you can do is you can either give it back to the shareholders by rebuying the shares, or you can go out and make an acquisition. So because there's been so much excess cash available, the tech companies have been generating a lot of cash. They are going ahead and doing a deal. And availability of target below intrinsic value. That obviously, for obvious reasons, you buy something if you get it cheap. The best example of that is Warren Buffett. In 2011, just after the financial crisis, everybody thought that Bank of America was going to go under. The share price fell to about $5. And at that point in time, Warren Buffett gave Brian Moynihan, the CEO of Bank of America, $5 billion and said, okay, give me the option, warrants to buy equity shares. 700 million equity shares at $7.14 is what the deal he struck. And today, the price of Bank of America share, when I last saw it, was $44. It's a cool $11 billion he made out of this deal because he realized that the market had overreacted and that the share price of Bank of America was significantly below its intrinsic value. The other reason, enhancement of share value. Again, if you think that you're not achieving the growth that you should be achieving, that you slow down, you're not being able to get the extra lift in your share price, then you go out and do a big acquisition. Because the reality is, if your multiple, let's say if your earning multiple is 20 times and you buy something for 8 times, then clearly there's arbitrage. Because when you take on this company, then the revenue of that company gets again valued at your multiple, which is significantly above the multiple at which you bought the business. So that is enhancement of share value. And then there's pressure from activist investors. This is a class that's become increasingly more important in today's world. And there is an example of EMC Corporation having to sell Dell computers because of pressure from an activist investor called Elliott Management. Similarly, there's another activist investor, very famous activist investor called Jana Partners, that compelled Qualcomm to sell its chips business. So you have pressure from activist investors who come on board and say, well, one way of increasing the value of the company is do a deal, either buy a business or sell a business. So these are again examples of financially driven motivation for doing a deal. Can we move on? So what happens is, what are the factors that sometimes result in no deal? So that is, firstly, you have a due diligence process. Now, due diligence can take many forms. It's financial due diligence, which is almost a must in any deal. Then there could be operational due diligence, commercial due diligence, and legal due diligence. Those are the 4 main types of due diligences that take place. And often when you do this due diligence process, you recognize certain risks that you had either not factored into the price or you weren't even aware of it. And when these risks come out, then the deal can often get aborted because you suddenly discover there's a asbestos case going on against the company that you're beginning to acquire, or there's some other legal infringement of patents, etc. They don't really have the technology that they said that they have. Well, the deal fails because you weren't aware of that risk when you priced it. And once you get to know of that risk, then you obviously decide to reprice the deal or abort the deal completely. Legal agreements, this doesn't really come up so much in the case of public company acquisitions, but when you're doing private company acquisitions, this is often a factor that can abort a deal. Things like what kind of minority protection. If you buy a 70% share, the guy who's left with 30% wants minority protection. He wants veto rights over certain decisions. So these can often result in a structure where you just can't get to agree with a minority shareholder as to what the rights of a minority protection, etc., should be, or you don't agree on reps and warranties, and that can often result in a deal not taking place. You might get the price right, but because you can't get the legal agreements right, you don't go ahead with the deal. And finally, something that has become increasingly important is regulatory approvals. Today, there is so much scrutiny of deals that are taking place. There's a Competition and Markets Authority in the UK. There's a Committee for Foreign Investment in the USA. There's the antitrust part of Department of Justice. So almost every transaction which is cross-border, I mean, famous example of TikTok, the transaction with Oracle failed because the US authorities decided they didn't want a Chinese company to have access to records, etc., in the US. So this is another factor that has to be taken into account and increasingly taken into account because regulators are showing their intent of coming down strongly on anti-competition, on consumer for consumer protection, etc. So you have to be cognizant that often you get everything right, but you fall at the last hurdle, which is regulatory approvals. And then the price is right. I mean, this is an axiom. the most important rule of deal making is willing buyer, willing seller. If you don't have a willing buyer and a willing seller, well, you don't have a deal. So there must be agreement on valuation, and valuation is determined in several ways. This is a topic in itself, but I'll just go through some of the main highlights on pricing. So one is future outlook. Future outlook. How do you expect the business to perform in the future? What kind of a moat does it have? What kind of barriers to entry does it have? How much of today, something that comes up very commonly in technology company valuations, you take on clients, how do you know you can monetize them? What percentage of these clients will actually monetize? How much can you cross-sell? So this is the future outlook of the company that determines the valuation. And the methodology that is often followed for this is something called discounted cash flow methodology. I won't go into the detail, but that is, it projects into the future and decides the valuation of the company based on discounted cash flows. Then there's comparable transaction and market multiples. There are transactions taking place all the time. There are some quoted companies which are similar to the business that you're buying, and you look at that as a pointer to what the valuation should be. And that is, in a way, it creates a spiral, because today tech companies are valued at stratospheric valuations. Something that an old timer like me finds very strange. It's not based on profitability. Most of these companies are making losses, but they're valued on their revenue, 10 times revenue, 20 times revenue. And so when you're looking at these examples and valuing a company, you end up saying, well, if this is quoting at 20, then this must quote at 20x revenue as well. And so you create a virtuous cycle where valuations continue to go up. But nevertheless, that is one way of deciding what is the value of a company. Availability of cheap debt. Now that has completely distorted valuations, because today debt is available at a very cheap rate. You can go out and do financial engineering. So you look at the return on equity, you take on debt at ridiculously low rates. Even junk debt was available at 7, 8%, 9%, where it used to be 18, 20, 25%. And because of that, you can justify paying a very high valuation, because your return on equity becomes that much higher, because you can go out and get debt for 70 or 80% of the deal. So that has driven valuations higher. Strength of strategy, rationale. So if you think that you must do a deal, then clearly you're willing to pay any price for it. And that results in a higher valuation than you might otherwise pay. And finally, the phrase that was made famous by Alan Greenspan, irrational exuberance. Sometimes you just pay because you're caught in the momentum. So even the legendary investor Warren Buffett, he admits today that he overpaid for Kraft and Heinz. He just got caught up and ended up paying a higher price. So there is irrational exuberance that often drives the price, but it gets factored into the valuation, and then the deal takes place. And finally, the most important rule is on the next slide, and which is momentum is everything in a deal. If you don't time the deal right, it is likely it's not going to happen. If you continue to wait, if the deal takes longer to complete, then something will happen. Either there'll be some change in market dynamics, there could be regulatory changes, there could be changes in the market, something would come out of left field that you've not anticipated. So it's important, if you have to do a deal, that you maintain the momentum, you time it right. It's like a marriage proposal, right? If you ask the question at the right time, will you marry me? The answer most likely is going to be yes, I will. If you wait for too long, well, then the moment is past. So like in everything else, even in deal making, momentum is absolutely of paramount importance. Thanks. That's all that I had for this presentation. Happy to answer any questions that you have.